Mark, first of all, just introduce yourself, please. Just tell me who you are and how you found yourself in this room and what your interest is in trading, really.
Sure. I'm Mark Fenton-O'Creevy. I'm a professor of organisational behaviour and I've been researching the financial behaviour of traders and other people in the world of finance for about 20 years now, perhaps a little bit more. I started off at London Business School, where a group of us did a very major study of about 118 traders across 4 City of London investment banks. I've carried on that research interest in traders ever since then. Nowadays I'm at the Open University, part of a centre called the True Potential Centre for the Public Understanding of Finance. And that interest is extended beyond financial professionals. I still work with financial professionals, but also to look at investor behaviour and consumer behaviour in terms of financial behaviour. How did I get involved in all of this? Well, we started off with this big study that we were interested in the psychology of risk-taking behaviour. Not especially in finance, but we figured that if we want to study risk-taking behaviour in business, then investment banks are a really interesting location, because all businesses have some component of risk as part of what they do, but investment banks are about risk. They're about intermediating risk, about understanding risk, about managing risk, about profiting from risk. So we thought we'd go and study risk-taking behaviour in investment banks. So we worked with colleagues in the finance faculty at London Business School who were very helpful in getting us in to investment banks, and finally got agreement from 4 major banks that we could do some in-depth interviews and a bunch of other things with traders. And 2 things really set me off on this now career-long, or at least half a career-long interest in financial behaviour. The first was that, to our surprise, these traders talked a great deal about their emotions and about how their emotions played into what they did in their trading. And the second was that my financial economist colleague, who had been involved with us from the start of the project, quite early on decided to drop out. And when pressed, confessed that his reason for doing so was, as he said to me, "Mark, nothing that these guys say to me makes any sense in terms of how I understand theories of how markets work. I don't understand what they're telling me they do. And I'm out of here." And I thought that was really interesting. So that also got me very interested in this question of what is it that traders and financial professionals do actually, as opposed to what do economists and even regulators think they do. So I think that's a really important question for us. And we've become very interested in really people's psychological and emotional relationships with money and with financial behaviour in all its aspects. But it really started right off with that strong interest in how traders talked about what they do. Really important things that came out of that early on. One of the things that was quite important for us was a part of that study was about biases that people may suffer from, and in particular traders were quite interested in something called the illusion of control. And we found some really interesting relationships between traders' propensity to an illusion of control and their performance. The stronger the illusion of control, the worse the performance, basically. We found that there were really big differences between traders in how they talked about the management of their emotions. And one of the things, perhaps unsurprising to people in that world, that we found that we thought was really quite important, was that effective management of your emotions, and that's not the same as not having them, by the way, effective management of your emotions was very much a characteristic of the more expert traders. There was a strong association between effective emotion management and expertise in trading. And another thing that we found really interesting was just how much traders talked about the use of intuition. And we found really big differences between high-performing and low-performing traders, not in whether they thought intuition was important, but in how they talk about and how they thought about intuition.